Every single morning, somewhere in a glass tower in Hartford, London, or Zurich, a group of mathematicians sit down in front of their screens and do something strange. They calculate, with terrifying precision, the exact year you are most likely to die. They calculate the probability that your house will burn down, that your car will be rear-ended on a Tuesday, that your back will give out before you turn 50. They are not doctors. They are not detectives. They are actuaries, and they work for the largest gambling operation in human history. You call it insurance. They call it something else entirely. They call it underwriting risk, and it is the most profitable bet ever invented because the house isn't Las Vegas. The house is the company that sends you a friendly reminder every month with a cheerful logo and a slogan about protection. The truth is simpler and darker than anything a casino could design. You are betting that something terrible will happen to you. The insurance company is betting that it won't. And every single year, across trillions of dollars in premiums collected around the world, they are right more often than they are wrong. Not by a little, by an enormous, systematic, mathematically guaranteed margin. In this video, we're going to pull apart the machinery of one of the most quietly powerful industries on Earth. We're going to look at how companies like Berkshire Hathaway, United Health, Allianz, and AIG have turned human anxiety into one of the most reliable money-printing operations ever built. We'll follow the dollar from the moment it leaves your bank account to the moment it becomes part of a multi-trillion-dollar investment empire that buys office towers, railroads, and entire portfolios of corporate bonds. By the end, you will never look at that monthly premium the same way again. To understand how insurance companies make billions, you have to understand the original sin of the industry. Insurance is not a service. Insurance is a bet. More specifically, it is a very particular kind of bet, structured in a very particular way, so that the person taking the bet almost always wins. Imagine you walked into a casino and the dealer said, "Give me $100 every month for the rest of your life, and if you ever break your leg, I'll pay you $10,000. At first, it sounds generous, but then you do the math. Most people don't break their leg in any given year. Most people go decades without a serious claim. Multiply $100 a month by 40 years, and the dealer has collected $48,000 from you before a single payout might ever happen. If your leg never breaks, the dealer keeps everything. If it does break, they pay out less than a quarter of what many other customers are paying in the same pool. Now multiply that across millions of customers. That is the business model. Insurance companies are in the business of collecting small, steady payments from a huge number of people, knowing with statistical certainty that only a tiny fraction of those people will ever file a claim in any given year. The word they use internally is the loss ratio, the percentage of premiums paid back out as claims. A well-run insurer aims to keep that loss ratio comfortably below 100%, meaning they collect more in premiums than they pay out in claims. The difference is called the underwriting profit, and for the best operators, it is only the appetizer. The main course comes from somewhere else entirely, and we'll get to that. The real engine of the insurance industry is not the premium. It is something far more exotic, and it has a name that sounds like it belongs in a financial thriller. It is called the float. Here is how the float works. When you pay your premium, the insurance company does not immediately set that money aside in a vault. They are not required to pay out a claim on you today. Statistically, they might not pay out a claim on you for 5, 10, 30 years, or ever. In the meantime, they hold your money. And while they hold it, they invest it. They take your $200 and the $200 from millions of other customers, and they pool it into a gigantic reservoir of cash. Then they send that cash into the financial markets. They buy government bonds. They buy corporate debt. They buy real estate. They buy stocks. They buy entire companies. The float is essentially a giant zero-interest loan that the public gives to the insurance industry forever in exchange for the promise of future protection. Warren Buffett, the most famous investor alive, figured this out decades ago. He built Berkshire Hathaway on top of the float generated by Geico and General Re. He has said openly and repeatedly that the float is the single most important asset his company owns. At last count, Berkshire was sitting on well over $160 billion of insurance float, which it invests into everything from Apple shares to freight railroads. The customers who paid those premiums never see a cent of the investment returns. Those returns belong entirely to the company. That is not a bug in the system. That is the system. Now, you might ask, if the premiums are so profitable and the float is so enormous, why do insurance companies still behave like they are one storm away from bankruptcy? The answer lies in the second great weapon of the industry, which is underwriting. Underwriting is the process by which insurers decide who is allowed into the pool, on what terms, and at what price. It sounds bureaucratic. It is, in fact, one of the most sophisticated data operations on the planet. Modern insurers ingest staggering amounts of information about you before they ever quote a policy. Your age, your postal code, your credit score, your driving record, your medical history, the year and trim of your car, the roof material on your house, the crime rate on your block, the distance from the nearest fire station, and in some markets, the contents of your social media. They feed all of it into actuarial models that output a single ruthless number, which is your expected cost to the company. If that expected cost is too high, they either refuse to insure you or they charge you a premium that guarantees them a profit even if you do file a claim. This is called risk selection, and it tilts the playing field before the first dollar is ever exchanged. The entire game is designed so that the customers most likely to need the insurance pay the highest prices, while the customers least likely to need it pay the lowest. The industry calls this efficient pricing. From the customer's perspective, it feels more like being charged the most, exactly when you can afford it the least. And that is how the house quietly keeps its edge, policy after policy, year after year. The third pillar of the insurance empire is something the industry rarely advertises, which is the fine print. Every insurance policy is a legal document, sometimes 30, 50, or 100 pages long, written in language so dense that even seasoned lawyers have to slow down to read it. Inside that document is an entire ecosystem of exclusions, limitations, waiting periods, deductibles, copays, caps, and conditions. In theory, these exist so the insurer can price the policy fairly and avoid paying for things it never agreed to cover. In practice, they also serve a second purpose, which is to give the company a legitimate reason to deny or reduce payouts when claims do arrive. Health insurance is the clearest example. A policyholder is diagnosed with a serious illness. They are then told the treatment is out of network, or not medically necessary, or subject to a pre-authorization they never requested. Auto insurers apply the same machinery. After a major storm, homeowners discover that flood damage is not covered under their standard homeowners policy because flood is a separate product entirely. Life insurers scrutinize death claims for any discrepancy on the original application, from an undisclosed health condition to a missed question about travel. The industry has an internal metric for how aggressively it defends the bottom line in the claims process. The more claims it can legally deny, delay, or reduce, the better its quarterly numbers look. None of this is fraud. All of it is written, signed, and agreed to. But the complexity itself is a moat. It ensures that the typical policyholder walking into a claim is outmatched by an institution that has spent decades perfecting the art of saying no politely. If what you are hearing is starting to reframe the way you think about the money that quietly leaves your account every month, take a second right now and tap the subscribe button. This channel, Titan Codex, exists to pull back the curtain on the biggest, most powerful, most opaque business empires on the planet. And insurance is only the beginning. Subscribe so you don't miss the next breakdown, because the stories behind the companies shaping your life are rarely the stories they want you to hear. The fourth layer of the insurance empire is reinsurance. And this is the part most customers never see because it happens entirely between companies. Reinsurance is insurance for insurance companies. We know when a primary insurer writes a policy, it takes on risk. If it writes millions of policies, it takes on a mountain of risk. To protect itself against a single catastrophic event that could wipe out its reserves, such as a hurricane, an earthquake, or a pandemic, the primary insurer buys a policy from a bigger company that specializes in absorbing those tail risks. These giants operate mostly out of places like Munich, Zurich, Hamilton in Bermuda, and London. Munich Re, Swiss Re, Hanover Re, and Berkshire's own reinsurance arm sit at the apex of a global pyramid of risk. They take premiums from the insurers below them, pool that money, and invest it in the same way primary insurers do, only on a vastly larger scale. Reinsurance is one of the most quietly powerful sectors in global finance. It is also the mechanism by which a single tornado in Oklahoma, a flood in Germany, and a wildfire in California can all end up as line items on the same balance sheet in Bermuda. When disasters happen, reinsurers pay and their share prices wobble. But over a long enough time horizon, the math still works out in their favor because their actuaries are even better funded, even more global, and even more sophisticated than the ones at the companies they insure. The result is an industry in which the risk is passed up the chain, repackaged, and transformed into yet another stream of premiums, another pool of float, and another engine of investment returns. The customer at the bottom of the pyramid, paying that monthly premium, is the foundation on which this entire structure rests. Once you understand premiums, float, underwriting, denials, and reinsurance, you start to see that an insurance company is not really a single business. It is three businesses stacked on top of each other, wearing the same logo. The first business is a statistical one. The company sells a product whose cost to produce is unknown at the time of sale and uses mathematics to estimate the cost as accurately as possible. The second business is an investment firm. The company takes the float, hires portfolio managers, builds positions in bonds, equities, and real assets, and generates returns that are often larger than the profit from the underwriting itself. The third business is a legal and operational machine. The company employs armies of claims adjusters, lawyers, compliance officers, and technology systems, all dedicated to enforcing the terms of the contract and managing the flow of payouts. The result is one of the most capital-efficient business models ever designed. In a good year, the statistical business breaks even or makes a small profit. The investment business generates billions. The legal and operational business keeps the friction low enough that customers keep renewing. Add all three together, and you get the quarterly results that make insurance stocks some of the most boring and reliable holdings in any pension fund on Earth. Boring is, in fact, a feature. The industry has learned that the less attention the public pays, the easier it is to compound those three stacked businesses, year after year, decade after decade, into sums of money so large they can buy entire sectors of the economy when no one is looking. To appreciate just how much money we are talking about, it helps to zoom out and look at the numbers. The global insurance industry collects somewhere in the neighborhood of $7 trillion in premiums each year. That is larger than the entire annual economic output of most countries on Earth. The assets managed on behalf of these premiums, the invested float, run well into the tens of trillions. Life insurers in particular control enormous long-duration pools of capital because the promises they are managing often stretch 50 or 60 years into the future. They become, by default, some of the biggest holders of government bonds, infrastructure projects, and commercial real estate in every major economy. When a state needs to build a new highway, an insurer is often sitting across the table. When a corporation issues billions in new debt, insurers are some of the first buyers on the phone. This is why during financial crises, regulators treat large insurers with almost the same nervous respect they reserve for banks. If a major insurer fails, the effects ripple through pension plans, sovereign debt markets, and corporate credit markets all at once. The industry has figured out how to sit at the center of the modern financial system while remaining, in the public imagination, a friendly pamphlet at the dentist's office. That gap between perception and power is not accidental. It is carefully cultivated through marketing, branding, and decades of reassurance that the man on the phone really is on your side. In reality, he works for one of the biggest investment operations on earth, and every dollar he can keep inside the company instead of paying out is a dollar that can be compounded somewhere else. It is worth pausing here to say something honest. Insurance, as a concept, is not a scam. The idea of pooling risk among a large group of people so that no single person is destroyed by a catastrophic event is one of the most important financial inventions in history. Without insurance, no one would build a ship. No one would finance a house. No hospital would open its doors. The mechanics of spreading risk have underwritten modern civilization in ways most people never think about. The problem is not the concept. The problem is what happens when the concept is run for profit at enormous scale by executives who answer to shareholders rather than to policyholders. The same structure that allows an insurer to stabilize your life during a disaster also allows it to extract wealth from you in silence when no disaster ever comes. The same float that builds reserves to pay future claims also becomes a private war chest that competes with you in the markets for assets, housing, and opportunities. The same fine print that protects against fraud also protects against legitimate claims that happen to be inconvenient in a given quarter. The question, then, is not whether insurance should exist. It obviously should. The question is how much of the surplus generated by risk pooling belongs to the customer, how much belongs to the shareholder, and how much belongs to the executive class that runs the system. In almost every country on Earth, the answer to that question has been written by the industry itself, through lobbying, regulation, and decades of carefully worded legislation. The result is the landscape we see today, where a small number of global insurers are permanent fixtures in the list of the largest and most profitable companies in the world. So the next time you open an envelope or an email with a cheerful logo and a reminder to renew, take a breath and remember what is actually happening. You are not buying a service. You are placing a bet on terms designed by a counterparty with more information than you, more capital than you, more lawyers than you, and a mathematical model of your life that you will never get to see. In most years, you will lose that bet and the company will keep your money. In the rare years you win, the company will still come out ahead across its entire portfolio of customers, because that is how the math has been engineered. That is not a reason to cancel every policy you own. Many of them are genuinely worth the price, especially for catastrophic risks you cannot afford to absorb yourself. It is a reason to pay attention. It is a reason to understand what you are buying, to read the contract, to compare providers, to challenge denied claims, to ask where your premium is being invested, and to stop thinking of the friendly face on the billboard as your friend. They are not your friend. They are a counterparty, and a very good one. If this kind of breakdown is the sort of thing you find useful, the next video you should watch right now on Titan Codex is our deep dive on how the largest banks quietly turn your deposits into some of the most powerful financial weapons in the global economy. It sits right on the end screen. Click it, because the story of how modern money actually flows is one most people are never told, and once you see it, you cannot unsee it. Thanks for watching, and we'll see you in the next one.